Hey there, fellow traders. Welcome to another exciting episode where we dive deep into the world of trading. Today, we're breaking down a trading phenomenon that can make you serious money. Bank Nifty gaps. These gaps are not just random occurrences. They are windows of opportunity that can be highly profitable if you know how to play them right. We're talking about those exciting moments when the Bank Nifty index opens significantly higher or lower than the previous day's close. These moments are filled with potential and can set the tone for the entire trading day. These gaps are like flashing neon signs, screaming trading opportunity. They are the market's way of telling you that something significant has happened and you need to pay attention. Why? Because they often signal a shift in market sentiment and create potentially profitable trading setups. When you see a gap, it's a clue that the market is reacting to new information, and this reaction can be leveraged for gains. So buckle up, because we're about to dive deep into the world of Bank Nifty gaps and how you can capitalize on them. This isn't just about spotting gaps. It's about understanding the underlying reasons and making informed decisions. Imagine this. You wake up, grab your coffee, and check the markets. It's a routine, but today, something catches your eye. Boom! The Bank Nifty is up a whopping 2% from yesterday's close. This isn't just a small move. It's a significant gap that could mean big opportunities. That, my friends, is a gap-up opening. It's a clear signal that the market is bullish and investors are optimistic. These gaps occur for various reasons: positive earnings reports, unexpected economic data, or even geopolitical events. Each of these factors can drive the market to open higher or lower. Even a simple surge in investor optimism. When the market is feeling good, gaps can be a common occurrence. Conversely, negative news or a bearish outlook can lead to gap-down openings, where the index opens significantly lower. These gaps can be just as profitable if you know how to trade them. Understanding the causes behind these gaps is crucial for developing profitable trading strategies. By knowing why a gap has occurred, you can better predict the market's next move and position yourself for success. Not all gaps are created equal. In the world of trading, gaps can tell you a lot about market sentiment and potential future movements. Just like there are different breeds of dogs, each with its own unique characteristics and behaviors, there are different types of Bank Nifty gaps, each with its own personality and implications for traders. Let's break them down in detail. Common gaps. These are your everyday run-of-the-mill gaps, often small and seemingly insignificant at first glance. They tend to get filled quickly, meaning the price moves back to the previous day's range. Traders often see these as opportunities for short-term gains. Breakaway gaps. Now, these are the exciting ones. They can signal the start of a new trend and are often accompanied by high trading volumes. Breakaway gaps occur at the beginning of a new trend and signal a significant shift in market sentiment. They can be a trader's best friend if identified correctly. Continuation gaps. As the name suggests, these gaps occur during a trend and signal its continuation. They indicate that the current trend is likely to persist. Exhaustion gaps. These are the tricksters of the gap family. They appear towards the end of a trend and can be misleading. They occur at the end of a trend, like a final burst of energy before a reversal. Recognizing these can save you from potential losses. Identifying the type of gap is crucial for determining your trading strategy. Each type of gap offers different opportunities and risks. For instance, you might want to buy a breakaway gap, but avoid trading an exhaustion gap. Understanding these nuances can make a gap-up opening gets the adrenaline pumping, doesn't it? It's like the market is giving you a head start in a race. But hold your horses. Before you hit the buy button, consider these strategies. Open above resistance. This is a classic bullish signal. If the Bank Nifty gaps up and opens above a key resistance level, It indicates strong buying pressure and potential for further upside. Gap up within resistance zone. A gap up that occurs within a well-defined resistance zone requires caution. While it may present a trading opportunity, be prepared for potential selling pressure as the price approaches the upper end of the zone. Gap up with fading momentum. Beware of gap ups that lack momentum. If the buying volume is weak, it could be a trap. Look for confirmation from other indicators before jumping in. Remember, trading is like surfing. You need to catch the right wave at the right time. Gap down days can be scary, like watching your favorite team fall behind in the first quarter. But don't panic. These situations can present excellent short-selling opportunities for savvy traders. Here's how to play it. Open below support. This is a classic bearish signal. If the Bank Nifty gaps down and opens below a key support level, it suggests strong selling pressure and potential for further downside. Gap down into a support zone. Be cautious when the index gaps down into a support zone. While it might seem like a good shorting opportunity, the price could bounce back from this area. Gap down with fading momentum. Similar to gap up scenarios, watch out for fading momentum. If the selling volume is weak, it could be a false signal. Remember, short selling is risky business. Only experienced traders should attempt it. Section 5. The Gap Fill Gamble. Should you take the bait? Gap filling is a common phenomenon where the price moves back to close the gap created by the previous session's gap opening. It's like the market has a short-term memory and wants to revisit its recent past. But should you trade based on this tendency? Some traders see gap fills as an opportunity to fade the move, meaning they trade against the direction of the gap. For example, if the market gaps up, they might look for short-selling opportunities, anticipating a gap fill. However, trading gap fills can be risky. Not all gaps get filled, and blindly fading every gap can lead to losses. It's crucial to analyze the context, consider other technical factors, and manage your risk effectively. Remember, gap filling is not a guaranteed outcome. It's just one piece of the puzzle in the complex world of trading. Section 6. Pro Tips. Navigate Bank Nifty gaps like a Wall Street wolf. Trading Bank Nifty gaps can be a lucrative endeavor, but it's not for the faint of heart. To help you navigate this volatile terrain, here are some pro tips. Volume confirmation. Always look for volume confirmation when trading gaps. High volume indicates strong conviction behind the move, while low volume suggests a lack of follow-through. CPR, Central Pivot Range. The CPR is a technical indicator that can help you identify potential support and resistance levels for the day. Use it to your advantage when analyzing gap setups. Pre-market data analysis. Before the market opens, analyze pre-market data, including international market performance and news headlines, to get a sense of potential gap openings. These tips are like having a secret weapon in your trading arsenal. Use them wisely, and you'll be well on your way to mastering the art of gap trading. Section 7. Risk Management. Protecting your trading bankroll. Trading, especially gap trading, involves inherent risks. It's like playing poker. You can't win every hand, and you need to manage your bankroll effectively to stay in the game. Here's how. Stop-loss orders. Always use stop-loss orders to limit your potential losses. Place your stop-loss orders strategically based on your risk tolerance and the technical setup. Position sizing. Never risk more than you can afford to lose on any single trade. Determine your position size based on your account balance and risk appetite. Avoid overtrading. Don't get caught up in the excitement of gap trading and overtrade. Stick to your trading plan, and don't chase every gap opening. Remember, protecting your capital is paramount. By implementing sound risk management techniques, you can trade with confidence and preserve your hard-earned money. Section 8. Technical Analysis, your secret weapon for gap trading. Technical analysis is your best friend when trading Bank Nifty gaps. It's like having a roadmap that helps you navigate the market's twists and turns. Here are some key tools to master candlestick patterns. Candlestick patterns, such as engulfing patterns and doji, can provide valuable insights into market sentiment and potential reversals. Moving averages. Moving averages can help you identify trends and potential support and resistance levels. Indicators. Use oscillators like the RSI, Relative Strength Index, and MACD, Moving Average Convergence Divergence, to gauge momentum and potential overbought or oversold conditions. By mastering these technical analysis tools, you can gain a significant edge in the market and make more informed trading decisions. Section 9. Patience and Discipline, the hallmarks of a master gap trader. In the fast-paced world of trading, patience and discipline are your greatest allies. These qualities are not just beneficial, they are essential for long-term success. It's like being a sniper. You need to wait for the perfect shot and not get trigger-happy. Just as a sniper waits for the ideal moment, a master gap trader waits for the right market conditions. Don't chase trades. Avoid chasing gap openings out of FOMO, fear of missing out. Chasing trades can lead to impulsive decisions and significant losses. Wait for confirmation from other signals and technical indicators before entering a trade. This ensures that your decisions are based on solid data and not on emotions. Stick to your plan. Develop a trading plan that outlines your entry and exit points, risk management strategy, and profit targets. A well-thought-out plan is your roadmap to success. Stick to your plan and don't let emotions cloud your judgment. Emotional trading often leads to mistakes and regret. Learn from your mistakes. Every trader makes mistakes. The difference between a novice and a master is the ability to learn and adapt. The key is to learn from them and improve your trading strategy. Continuous improvement is the hallmark of a successful trader. Keep a trading journal to track your trades and analyze your performance. This helps you identify patterns and areas for improvement. Remember, trading is a marathon, not a sprint. Success in trading requires endurance, persistence, and a long-term perspective. By cultivating patience and discipline, you can weather the inevitable storms and achieve long-term success in the markets. These qualities will help you stay calm during market volatility and celebrate your successes with confidence.